So every investor, right, you face this exact same problem. You've got all these options in front of you, but how do you actually know which one is the best? I mean, really the best? Well, it's not as simple as it looks. Let's dive in and find out why.
Okay, so let's imagine this scenario. You have to pick between these four options. You've got Fund A, Fund B, Fund C, and just a plain old market index fund. What we're looking at here are their annual returns over a 4-year stretch. And you can already see each one has a totally different story to tell, right?
So your goal is simple. Pick the winner, the one that's going to make your money work the hardest. But how? I mean, what's the right way to measure performance in the first place? Where do you even start? All right, let's talk about the obvious answer and why it's wrong. So let's start with the most intuitive way to do this, the thing pretty much everyone thinks of first. We just look at the average return and, pick the highest number. Easy peasy, right? Okay, first up, Fund A. We run the numbers on its 4-year performance, and it spits out a pretty respectable average return, 5.5%. Not bad, a solid start.
Then we've got Fund B, and whoa, it just blows past Fund A with a seriously impressive 8% average. So right now, you're probably thinking, okay, this is our front runner.
And then there's Fund C, kind of lagging behind the pack here, with an average return of just 2%.
And finally, what about our benchmark, the market itself? It averaged 2.5%. So just looking at this, A and B are crushing it, and C, well, C didn't quite make the cut.
So, if we're only looking at this one number, the answer seems crystal clear, doesn't it? Fund B, with that awesome 8% return, is the undisputed champ. Case closed. Or is it?
Well, not so fast, because here's the massive, gaping hole in that logic. This super simple answer completely, totally ignores the other half of the story. And it's a really important half: risk. All right, the plot thickens. To get a real picture of performance, we absolutely have to bring risk into the equation. Think about it. An 8% return you got from a crazy, stomach-churning roller coaster ride is a totally different beast than a calm, steady 8% return. So how do we actually put a number on that roller coaster ride? Well, in finance, the go-to tool for this is something called standard deviation. The name sounds a little technical, but the idea is super simple. Just think of it as a wildness score for an investment. A high number means a really bumpy journey with lots of ups and downs, so more risk. A low number, that means a much smoother, more predictable ride.
Okay, so let's go back to our funds. But this time, look, we're adding that super important second column for risk. That's our standard deviation. Now the picture is starting to get a little more complete.
And suddenly, things get complicated. I mean, who's the winner now? Fund B still has that amazing 8% return, but just look at its risk number. It's almost 17%. That is way, way more volatile than Fund A. So now, what do? Which is better, the high return with a ton of risk, or the lower return with a lot less risk? And this right here is the problem. We're completely stuck. We're trying to compare these pairs of numbers, and it's like comparing apples and oranges. There's no obvious way to rank them, so we can't make a clear decision. We're kind of paralyzed. This is the solution, the Sharpe Ratio. This exact problem is what the brilliant economist William F. Sharpe wanted to solve. And he did. He gave us this incredibly elegant tool that just cuts right through all that confusion. It's a way to boil down return and risk into one single powerful number that you can actually compare.
So here it is, the famous Sharpe Ratio formula. Now, it might look a little scary at first, but the idea behind it is actually pretty straightforward. Basically, you take the return you got, then you subtract the return you could have gotten from something totally safe, like a government bond. That gives you your extra return. Then you just divide that extra return by the amount of risk you took. That's it. It all boils down to one simple question. How much reward did I get for the risk I took on?
So how do you calculate it? It's really just a 3-step process. Step 1, figure out your excess return. That's just a fancy way of saying, how much more did you make compared to a totally risk-free investment? Step 2, you take that extra return and you divide it by the investment's risk score, its standard deviation. And step 3, that's it. The number you get is the Sharpe Ratio. It's your risk-adjusted score. And the rule is simple. The higher the number, the better the investment.
Okay, this is it. The final ranking, the moment of truth.
Let's take this powerful little formula, apply it to our 4 funds, and finally get a clear ranking that tells the whole story, not just half of it.
And wow, the results are pretty amazing. Check this out. Fund A, the one that seemed kinda decent but not amazing, it's actually our #1 performer. And Fund B, our supposed champion with the highest return, it drops all the way to 2nd place. Why? Simple. That huge return it got just wasn't enough to justify the massive amount of risk you had to take on. The Sharpe ratio tells us the real story.
But that's not even the coolest part. The real power of the Sharpe ratio is that it lets us compare apples and oranges. Its real magic is that it's a universal tool. It gives us one single yardstick we can use to compare completely different kinds of investments.
So let's look at a classic matchup. Which is the better investment? On one side, you've got a stock portfolio. It's got a big, juicy 12% average return, but also a decent amount of risk. On the other side, a super conservative bond portfolio. Its return is way smaller, only 4.2%, but its risk is tiny. Your gut probably tells you to go for the 12%, right?
Okay, so we run the numbers. The stock portfolio gets a Sharpe ratio of 0.026. That's its final score, its performance per unit of risk. Now let's see how the bonds did.
And here's the twist. The bond portfolio's Sharpe ratio is actually higher. It comes in at 0.035. So even though its headline return was way lower, it was actually the more efficient investment. It delivered more bang for your buck for the tiny amount of risk you had to take. And this really gets us to the heart of the matter. The Sharpe ratio, it's not just some math formula. It's a whole new way of thinking about investing. It forces you to ask a much smarter question. Not just what was my return, but what was my return for the amount of risk I took. It's like judging a car not just on its top speed, but on its fuel efficiency. So I'll leave you with this question. If you're not looking at your investments on a risk-adjusted basis, what are you really measuring?